Coming up today, stocks trade mixed to start a new month. Are we in for a sober January? How Cyber Week sales are performing, the latest from the Fed, and the bullish signals we just got from the market, along with everything else happening this week. Let's have a good one, guys. And welcome back, everybody, to the daily market review on the first trading day of December. Even though the S&P 500 tracked up, it was largely driven by mega cap tech, as most sectors actually finished in the red today, and we had a few pullbacks in some other stocks, all of which I'll get into soon. And it is a bit of a busy week to start the month off. We had manufacturing PMI coming today, better than expected. Then tomorrow we got JOLTS job openings. Wednesday, ADP payrolls, along with ISM services PMI. Thursday, jobless claims. Then on to the first Friday of the month, jobs report, non-farm payrolls. US economy expected to have generated 200,000 new jobs for the month of November, with the unemployment rate 4.2%. We'll also get consumer sentiment on Friday. And just quickly, before I dive into all the hottest charts and news from today, I just want to congratulate everybody who secured their spot in my new swing trading alert service, as all available spots are taken and it's now closed to new subscribers. So to everybody who's jumped on board, I'm excited to begin this new journey with you guys. I'm going to do my best to achieve the outline objectives, and I look forward to meeting you all in Vegas. So thanks once again for joining me on this new adventure. And so just getting back into the market, once again, a lot of dispersion. There's the sector performance today. Everything from communications up 0.18% to utilities down over 2%. That's why they call it a stock picker's market, because not all sectors are acting the same. We've got quite a lot of dispersion. And like I said, most sectors finished down today, but what really drove the market, mega cap tech, Microsoft having a big day there. Meta almost back to all-time highs, up 3.2%, and we're getting a nice little bounce in semiconductors, one of the best performing sectors today, up 2.3%. Big bounce up there for Taiwan Semi, 5.2%, and a very good rally today for Supermicro Computer, up 28% on Monster Volume, as they got all the clear after completing a compliance audit. It's what the market was really worried about a few weeks ago. However, they seem to have cleared all that up now, and so that's a good sign for the overall sector, as that was a bit of a tail risk, as they were talking about potentially delisting Supermicro. So that looks all good. However, we did get signs today of a little profit taking in some of the hottest parts of the market of late. These early stage small cap growth names. Joby Aviation, big bearish engulfing candle there today, along with Archer Aviation, that other eVTOL stock. Pretty significant reversal candle there today. We did get quite overheated this last week, and as my stock picks members know, I took profits and locked in gains on one of my best performers this year, as my portfolio too had been super hot, so I wanted to take a little bit of heat out of it. As no doubt these names are due for a bit of a pullback. Another one, Rocket Lab, bit of a bearish engulfing candle as well. Red Cat Holdings, bearish cloud cover, along with quantum computing, having a bit of a pullback there today, led by the biggest IonQ, and even the hot nuclear trade, bit of a bearish candle there today, still above moving averages. So at this stage, this looks like a normal profit taking and pullback. We don't have confirmation of a trend change just yet. However, us uranium bulls did get a good signal. Apparently, Kramer just stated bearish on uranium, so that's a good sign for us at least. However, I did notice a different group of stocks catch a bid today. Some small biotechs in the field of gene editing, which is another future industry and still very early stage as well. So looking at one here, Cure, Verve Therapeutics, solid rip there today, along with CRISPR, ticker symbol CRSP, big thrust off a low. And the one I find most interesting, Ginkgo Bioworks, ticker symbol DNA. And here's a look at their website here. Again, early stage, very innovative, long-term, speculative stock, cash flow negative, so they're burning cash. However, they're kind of like a Taiwan Semi platform that other companies can use to kind of outsource synthetic biology, basically manipulating DNA to create new products as another kind of frontier industry. And so it has many applications across a lot of different industries. It's been founded and backed by MIT professors, pretty capable management team. However, the stock has been beaten down so hard the last couple of years, most likely targeted by short sellers, as they are burning through cash, so they're an easy target. But it certainly is an interesting stock I've got on my watch list. It could be one of those things that takes many, many years to kind of play out. Because like I said, there's a look at DNA over the last couple of years. Stock's been absolutely smashed. However, we are getting big volumes coming in these last couple of months here. Current market cap, just over 550 million. So if they ever did get close to being cash flow positive, I can imagine a stock like this would gain a lot of attention and excitement from investors, especially with a ticker symbol like DNA. So we'll keep an eye on this one. Otherwise, just getting back to the market. Once again, drifting high on really low volatility here today. It was the Qs pushing up, while we got a little bit of a pullback in the Dow and mid caps. And we're just a few weeks away from wrapping up 2024 and what has been a pretty good year for the market, exceeding all expectations. Even the most bullish forecasts coming from Wall Street, as S&P 500 has surged 27%, one of its best years ever. And that's based on a few reasons. The economy's held up a lot better than expected. Once again, just like last year, we came into this year with a big consensus. We're on the verge of a recession. seems to be continually pushed back and back. And just looking at the bond yield curve spread of the 10-year and the 2-year, it's pretty much back at break even. If that goes back to inverted territory, maybe the clock gets reset again on when we should expect a recession. And it looks like the Goldilocks soft landing is continuing. Economic growth holding up, corporate EPS holding up, along with inflation pulling back, which has allowed the Fed to cut interest rates as well. Now we're past the presidential election. It wasn't contested. It was a clean sweep and a landslide victory, and the AI trade is still in full swing. But it's not just those hot chip stocks. The story of 2024 has been a broadening of the bull market, not just in price gains, but also in earnings. Small caps, mid caps catching up. So what are we looking at for next year? I think the bull market's still intact. It may just take a bit of a breather. And I don't really do end of year price targets, but if I had to give one, I'd probably join JP Morgan and expecting an 8% return next year. With no doubt a few pullbacks, correction, and a volatility episode or two by the time we get that 8% come Christmas next year. According to UBS, they've got their eye on 4 sectors they think are best positioned to rally into next year. Tech remains their top sector pick on the back of the AI boom. They're also positive on financials due to pro-business policies and deregulations, along with corporate tax cuts expected to come in next year. And they're also liking industrials and utilities as well, with utilities potentially performing well if the market did pull back due to their defensive nature, along with the bull market and the huge surge in demand for electricity. It's why utilities also up over 20%, having one of their best years on record, as they're normally very low volatility. However, has the market got a little ahead of its skis? I think we're in for a 5-10% pullback come February or March. Kind of be hard to see the market continuing to grind up all the way through a new incoming admin, along with tariffs and big changes in policies. I think it's highly likely to cause a bit of volatility, even if it's a good thing, just while the market digests it all, along with a bit of profit taking as well. According to FundStrap's Tom Lee, he thinks the S&P is going to finish this month at 6,300, but with a risk of zone of hesitation in the next 2 weeks. And he's actually urging investors to buy the dip. And the stats do back up his narrative. December is historically the best performing month for the S&P 500. On average, finishes higher 74% of the time, with an average gain of 1.32%. And doing even better over the November-January period is the Russell 2000 small caps, along with the relative performance versus large caps. Again, the best period, December through February. Small caps can do better than large caps. However, according to Wharton professor Jeremy Siegel, he's saying get ready for weaker returns in 2025 after huge stock gains in the last 2 years. He sees gains capped at 10% next year, and he expects large cap tech shares could actually be flat, but he likes undervalued small and mid cap stocks. And according to Dan Ives from Wedbush Securities, he expects tech stocks to be strong with a sounder rally as the street further digests a less regulatory spider web, stronger AI initiatives, and a Goldilocks foundation for big tech and Tesla. He's really taken a liking to these last few months. However, not everybody's still on the bullish train. According to one market analyst, an overhyped US market is stoking the mother of all bubbles. And that's Rusha Sharma for the Financial Times saying, foreign investors are fueling the mother of all bubbles. Global investors are committing more capital to a single country than ever before in modern history. And whilst that's true, I don't think you can undermine the solid reasons for that. The most important sector in the market and our lives now and going forward is technology. And the fact is US technology companies simply dominate all Western markets and even other international and emerging markets as well. I don't think that's going to change anytime soon. Along with the ease and accessibility, the breadth and the depth of the US market, you can't just say something's hit a record, therefore it must go back. More importantly, you've got to understand what's driven that record and then pay attention to those underlying drivers to see whether we'll see a reversion of the mean. Is possible. I just don't see it happening anytime soon. And like I said, American exceptionalism could actually be on the verge of accelerating. And we are continuing to get more bullish technical signals, with 2 more significant ones today. The first being a VIX crush. And looking back in history, when the VIX goes from above 20 to below 14, that's typically a really bullish signal. In fact, according to Sediment Trader, looking back in history, the stock market's higher 6 months later 88% of the time, and 12 months later 96% of the time, for a median gain of 14.2%. I like those odds. And the second indicator they've found a really bullish signal in is their last hour indicator, which tracks the cumulative direction of the final hour of trading for the S&P 500. It's posted gains in 9 out of the last 10 sessions, signaling traders rushing to complete buy orders amid wariness over the upward drift that often characterizes rising markets. Looking at the past 21 times, the indicator saw a rise in 9 out of 10 sessions, with the S&P 500 within 2% of its all-time high. The index rose 90% of the time over the following 6 months. And I'm seeing the same thing too, looking at the volatility risk premium. Regular viewers know I often pay attention to this, clues on the market. It's kind of like a volatility forecast from option dealers, which are mostly right most of the time. And so currently the VIX index at 13.3 is lower than the realized volatility index at 13.8. And so what the VIX index is, that's kind of an average implied volatility of S&P options over the next 30 days. So in other words, option dealers a pricing movement over the next month at an annualized rate of 13.33%. Currently, the S&P 500 is moving at an annualized rate of 13.88%. So that gives us a negative volatility risk premium, VRP. Translation, option dealers are not expecting too much volatility over the next month. They're happy to underwrite volatility insurance for a lower price than what stocks are actually moving in the market. And so that too is a bullish signal. But again, you can't just look at stats, bullish or bearish. You can't just say something's gone so far, so it has to revert. As long as the US economy holds up along with corporate earnings, it's going to be very hard for the stock market to have a correction greater than 10-15%. And we're just getting more and more data from retailers as the busy holiday spending period kicks off. Black Friday, Cyber Monday. So far, so good. In fact, we're on track for a brand new record. Consumers spent $10.8 billion on Friday, a 10.2% jump from the previous year. Shoppers projected to spend $241 billion just online in this holiday season. That's almost $250 billion. Cyber Monday is expected to be the season's biggest shopping day with a record $13.2 billion estimated spend. And that's up over 6% from last year. And while we're seeing the biggest beneficiaries like Amazon trade pretty firm here today, up 1.3%, it too just a few points below all-time highs. And this holiday period looks to be so strong that retail stocks as a group just last week broke out of this months-long consolidation all year basically. Not even the threat of tariffs is enough to spook them. So translation, consumer spending is good for the here and now. The market and economy looks to be on firm footing. Of course, things can change quickly, but for the here and now, things are okay. And they've actually been improving a lot over the last couple of months. Price of gas has been coming down. And looking at Goldman Sachs' social media economic sentiment index, actually just broken out to a new multi-year high. So consumers are starting to feel better about the here and now and what's around the corner. And just looking at TSA checkpoint numbers, yesterday was an all-time high. More than 3 million passengers went through TSA checkpoints. Huge gain from last year, more than 20%. So consumers are out there traveling and spending. And just looking at Goldman Sachs and their forecast for non-farm payrolls this Friday, economists expect 200,000. They're expecting 235,000 new jobs were created in November as striking workers return and the hurricane hits mostly reverses. And just looking at the price action of some of the most important stocks in the market, Tesla being one of them. Once again, on really firm footing here, having another great day, pushing up to this all-time high zone after the street is becoming more and more bullish on the stock after their recent earnings blowout. Musk's now best friends with the incoming president, along with several key catalysts around the corner. In fact, according to one guy I follow, who's an avid Tesla investor, engineer, venture capitalist, who's pretty much been all in on Tesla since 2013. He just posted on X today, I expect Optimus to be available for sale in the next 6 to 9 months, which would be huge if true. Even if we got it by this time next year, or even early 26, that is going to be enough to get the market really excited. Transformative product, and just like Tesla leads in EVs, battery storage, they're likely to lead on personal and commercial robots, autonomous driving, cyber cabs, and who knows what else they could get into. There's a look at the daily chart, pretty solid uptrend. That was when they unveiled the cyber cab, robo-taxi, that presentation, stock gap down, then we had the blowout earnings, and it's been on a rip ever since. There's a look at the monthly chart, pushing up again to those 2021 highs. And it's still looking likely the Fed will cut rates in a few weeks. We heard that again today from Federal Reserve Governor Christopher Waller. Said even though declines in inflation have been stalling, he is still leaning towards lowering interest rates further this month. And I think so too, unless we get a really upside surprise on CPI, PCE. I think the Fed will go ahead and cut another 25 basis points, but their path next year is a little more uncertain, as the media has been telling us that tariffs are going to increase inflation, and that's becoming a bit of a narrative. However, just looking at the data, the last time Trump enacted tariffs, it didn't really change inflation at all, because tariffs don't actually increase the supply of currency. That's what government spending and actually the Federal Reserve does. And that's why we saw the huge increase in inflation after that record government spending and Federal Reserve money printing. However, I think inflation may have found a new floor around 2.5, and 3 may be the new 2. All that new currency isn't just going to wash out overnight, and I'd say we'd need a recession for inflation to get below 2% again anytime soon. Otherwise, we very well could uptick towards 4%, possibly because the economy just overheats, things become too good. But as investors, we can hedge that risk out. So I'm still saying gold's likely to beat stocks over the near term. I think gold may have got a little too heated of late as well. It's quite pulled back ever since the election. I think a lot of geopolitical risk premiums coming out of it. But there are plenty of other commodities that still look good, commodities that will be needed well into the future. Silver, copper, nickel, uranium, lithium, amongst a few others as well. There's a look at gold. Seems to be consolidating now, along with a bit of a pullback in silver and crude just bumping around as well. This big support zone could very well be tested again soon. And just rounding out some news today, an interesting post that caught my eye from Grant Cardone, real estate investor and fund manager. Eliminate the IRS, flat tax on purchases, make America the world's tax haven, no tax on personal income, corporate income, capital gains, interest earned, and no gift tax, inheritance tax, or death tax. No withholding. Whatever you get paid, you keep. Our economy would boom. We would grow our economy by 10 to 12% a year, reduce our budget deficit, and trillions of corporation dollars would come home. Now, wouldn't that be nice if you only paid tax on the stuff you buy? Now, of course, this is highly unlikely to happen. We would need such a big drastic change in the government. They would have to cut their spending by 70, 80% or something like that. But one thing for sure, I do agree, and I'm sure a lot of you do as well, is the inheritance tax or death tax. It's kind of crazy. You work your whole life, give away about a third of what you make to the government in tax, not to mention the taxes on goods and services. Then you give away another third when you pass away on money that's already been taxed. Doesn't make sense. And that's why we all have to push back on taxes. Otherwise, the government will just keep taxing everything they possibly can. But if it were up to me, I could write the tax code in one page, and it would be no tax on anything under $50,000 earned, flat tax of 15% on everything above that, along with 15% on goods and services. No deductions, no BS, not a million pages of tax code. You need a forensic accountant to figure it all out. Just flat 15 across the board on anything above 50,000. And I'm sure a lot of you guys would agree with that as well. And that pretty much wraps up the daily market review today, guys. Thanks for tuning in with me on what looks to be a bit of a sleepy start to this week. But like I said, we do have a number of economic releases due, PMIs, and a good look at the jobs market this week, due out on Friday morning. Otherwise, retail spending, along with the price action and retail stocks, pretty good. But just looking at sector breadth, we did have a bit of a pullback there today in a number of sectors. But still otherwise a healthy rotation, which is a sign of a bull market, along with those two bullish signals from the VIX crash and last hour buying and December month seasonality. The market still looks to be on firm footing here. Thanks very much, and I'll see you guys again this time tomorrow. Cheers.